morning, traders. This is your Forex market commentary brought to you by Real ECN. Today's commentary will encompass the euro-dollar market. A dramatic rise in the US non-farm payroll print and a drop in unemployment rate exceeding estimate did very little to impress the market, as the euro-dollar cross struck off the report and continued trading in the upper 1.3800 level. This week is packed full of market-moving risk events out from the Eurozone, which will provide the volatility-inducing catalyst for the single currency, and the highly anticipated ECB press conference will allow the market to see whether ECB President Mario Draghi will instigate the second wave of verbal intervention to dampen further euro strength. I hope that this commentary will prove to be insightful for our traders in formulating a successful trading strategy. First, in line with this commentary, we will examine the euro-dollar market on the technical front. Here we have the euro-dollar pair on the hourly time interval. The euro-dollar market opens today's Sydney trading session slightly below the 78.6% retracement zone between the March and April decline near the 1.3900. Last Friday, US non-farm payroll print failed to trigger a sustained breakout for the greenback as the market struck off the upbeat US employment print and allowed the single currency to retrace all the losses by the end of Friday's trading session. In according to SSI, which is also known as the Speculative Sentiment Index, net retail traders' sentiment on the single currency has been relatively bearish. Traders continue to take every opportunity to short every advancement in the euro. Therefore, analysts would suggest taking the contrarian view to the sentiment extreme and favors further euro rally. Currently, there are 5 net short euro positions for every 1 long euro position taking up by retail traders against the greenback. On the intramonth level, April has proven to be a low volatility and consolidated period for the euro-dollar pair. Analysts also believe that on the technical front, the euro may test the 1.3966 resistance level, and once the pair can take out this zone, it will expose the single currency to the 1.400 psychological level. It is at this level where a meaningful top may be established. Analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bullish market sentiment and recommend long positions on the euro. The hourly chart showed that the single currency opened today's Sydney trading session inching closer to its established solid resistance level at 1.3906, while the solid support level is set at 1.3811. Going into this week's trading session, the euro bullish bias is also maintained, which allowed the euro-dollar cross to continue to trade above the 200-day simple moving average. Therefore, the long-term outlook on the single currency has been upgraded to bullish if the trend line continues to trade above the 200 days. This trend action holds great significance as 200-day simple moving average contains more or less 1 year's worth of trading data and the forecast long-term market sentiment. The bullish long-term outlook on the euro-dollar pair is not shared by its short-term moving average counterparts, as the euro-dollar pair opened today's Sydney trading session below the 5 and 10 but above the 20 and 30-day simple moving average. Collectively, this is indicative of a neutral recommendation on the short-term moving average front. So it is important to highlight this week's risk event, which will provide us with a volatility-inducing opportunity for the euro-dollar market. On Monday, we have the US ISM non-manufacturing PMI forecast to come in at 54.1. On Tuesday, we have the German service PMI forecast at 55.0, while the Eurozone service PMI is forecast to read at 53.1. Also, Eurozone retail sales month-on-month forecast to contract by 0.2%. On Wednesday, we have Fed Chairman Janet Yellen testify, with Friday Eurozone interest rate decision and ECB press conference. Moving on to the fundamental aspect of the euro-dollar market, the release of US non-farm payroll report and unemployment print did very little to support the greenback. Closely examining the non-farm payroll print will allow investors to understand the reason behind the muted reaction in the market. Upon the release of the US non-farm payroll print, the greenback briefly responded positively to the upbeat employment print and traded higher against the single currency. However, this bullish momentum was short-lived as the euro-dollar pair retraced all of its losses by the end of Friday's trading session. Despite the US non-farm payroll print rising the most since January of 2012 and employment rate dropping more than what the market could ever anticipate, it wasn't enough to convince the market to support the greenback momentum. The US economy added 288,000 non-farm employment jobs for the month of April, up from 203,000 jobs from the previous reading, while unemployment rate fell to 6.3% from 6.7%. However, reading between the lines, the market understood that even though the economy added more jobs, the labor participation has fallen significantly as 805,000 people stopped looking for jobs, thus supporting the drop in unemployment rate. In addition to the average minimum wage has stalled, which ultimately hurt money velocity and future CPI print. The next risk opportunity left in the Fed is the Fed Janet Yellen announcement this week, as the market is looking to see whether the next Fed announcement will affect the improvement in the US non-farm payroll print. Most analysts expect the Fed to keep the status quo on monetary policy. What most likely will happen is Janet Yellen will attempt to intervene in the market expectation on interest rate hike by reaffirming that tapering action does not equate to tightening undertone, or in an attempt to keep the downward pressure on the US Treasury yield. Some analysts believe that this dramatic drop in labor participation rate will work against the market interest rate expectation, as the Fed will be more inclined to keep interest rate low for a record period of time to accommodate and encourage the return of long-term unemployment back into the labor market. At the current pace of tapering, QE will come into completion around October or December of 2014, and hinting from Janet Yellen's last revelation to the press that interest rate hike will be implemented 6 months after the completion of tapering, traders are expecting the first interest rate hike to come in between April and June of 2015. However, this expectation will only hold true if the Fed revises dovish rhetorical in the near term. The muted reaction to the upbeat US non-farm payroll print by the market has investor pricing in that risk appetite will continue to remain strong for the reason that the US dollar will continue to remain the funding currency in an environment where the Fed is happy with downplaying interest rate expectation. This week, risk event will move the euro-dollar market will likely stem from the Eurozone, as inflation, consumer spending, and industrial production print is due for release. ECB President Mario Draghi will also hold a press conference, and in line with market expectation, investors are expecting Mario Draghi to maintain the status quo on its monetary policy front. Nevertheless, Mario Draghi rhetorical will be a volatility-inducing effect on the single currency, as the pair is trading closer to the 1.3900 zone. This threat to the strength of the euro remain, as Mario Draghi will attempt to further talk down the euro with more easing policy. I hope that this commentary will prove to be insightful for everybody, and once again, thank you for your time, everyone, and have a successful trading session.